So we're given the following information relates to all years under review. Credit balances are in brackets. Changes in PPE relate only to depreciation for accounting purposes and wear and tear for tax purposes. SARS allows warranty costs as a deduction when they are incurred. All tables do not include the effect of the deferred tax on assessed losses where applicable. The financial year end of the company is 31st December. The following information reflects temporary differences relating to recognized assets and liabilities in H&M Limited at 31st December 2023. So we have PPE and a provision for warranty costs. Okay? We're given the carrying amount, the tax base, the temporary difference, and the deferred tax. Okay. Then we're told for financial year end 2024, during the 2024 year, H&M experienced a downturn because of new competitors who had entered the market and were selling their product at a considerable discount to H&M's prices. A loss of 1 million rand was incurred for 2024. Yeah, we need to take note that this is actually an accounting loss. Right? Very important to keep the two separate. Otherwise, you can end up losing a lot of marks, which is not nice. So keep them separate. So we have an accounting loss of 1 million rand for 2024. The reason I know is because if it was tax, they would have said assessed loss. Right? So they don't always have to say accounting loss, but for tax, they do have to say assessed loss. Right? So a loss triggers accounting loss. Budgets for 2025 show that H&M is expected to incur losses in 2025 and that profits cannot be anticipated. Right, so in other words, it is not probable that there will be sufficient taxable temporary differences until H&M has completed the development of new products. Temporary differences relating to recognized assets and liabilities in H&M at 31st December 2024. Again, we just have PPE and warranty costs, and we're given the carrying amount, the tax base, and the temporary difference. Okay. And then we're told during 2025, H&M reverted to earning profits because customers preferred the quality of its products. Increasing profits are forecast for the foreseeable future. So now in 2025, we return to a state where it is probable that there will be sufficient taxable temporary differences. Right. So now, here, when there wasn't, we could only recognize our assessed losses to the extent that there was sufficient that there were taxable temporary differences. Now we can recognize all assessed losses. Okay. The accounting profit before tax for the 2025 year of assessment, okay, accounting profit before tax was 850,000. So not tax, right? Discounting. Temporary differences relating to recognized assets and liabilities in H&M at 31st December 2025. We're just given PPE and provision for warranty costs, where we're given the carrying amount, the tax base, and the temporary difference. I just want to make sure you see the same colors still. Okay. Then the required reads as follows. Prepare the journal entries to recognize current and deferred tax in the financial records for H&M Limited for the 2024 and 2025 financial years. Show all calculations. Journal dates and narrations are not required. And then the second one says, prepare the tax rate recon. Okay. For completeness purposes, I'll just do the entire thing. Yeah. Make it nice. We'll do the entire thing. To be included in the notes to the annual financial statements of H&M Limited for the year ended 31st December 2024 and 2025 in numerical format, comparative amounts other than what is required above are not required. Okay, so we only need comparatives for 2024 and 2025. Okay, cool. So what I'm going to do is the two required. I'm going to deal with required A, required B for 2024, then deal with required A, required B for 2025. Those might end up being two separate videos. Okay, so let me open up Excel so we can actually do this thing. That would be a good starting point, I guess. Okay, so we'll start off with our calculations. Okay, let's call this required A. Start off with our calculations. I like that. Okay, so let's start off with our current tax. We were told that we had a loss, so loss, um, current tax. We're told we had a loss for the year of R1 million. Then we were given 2023. Remember this, if you use the A&L method, right? Like this, we have carrying amount, tax-based temporary difference, deferred tax. That gives you the deferred tax balance. For current tax, right? Or if we're gonna do the P&L method, you need the deferred tax movement, right? For current tax. So to get the deferred tax movement from the balance, you take the current year's closing balance and subtract it from the current year's opening balance or the um, previous year's closing balance, right? So to get the movement, we're just going to take this minus this, right? Now we're told that changes only related to depreciation and wear and tear, so we can just take the difference for each, right? So PPE had a carrying amount of, sorry, we had a temporary difference of sorry, no, carrying amount. So depreciation, because that's what sits in the statement of profit or loss. Remember here, for the P&L method, you can only touch items that sit on the statement of profit or loss. So if they sit in the statement, if they sit in other comprehensive income or the statement of financial position, you cannot include it in the statement of profit or loss, right? So an example would be if something was capitalized, then you can't show it on the statement of profit or loss here. Sorry, on the P&L method, because it doesn't sit in profit and loss. Okay. So if you're doing the P&L method, you can only do stuff that actually affects the profit and loss. Right? Okay, so let's go. So we had a carrying amount of R1 million. Now we have a carrying amount of 900,000. All we're doing on the P&L method is we're trying to get to taxable income. To do that, you start with accounting profit or loss, eliminate the accounting treatment. So if it's an expense, you add it. If it's an income, you subtract it, right? And then bring in the tax expense. So if it's going to be in gross income or an allowance, you're going to add it. If it's a deduction or an exemption, you're going to then subtract it. Okay. So depreciation, let's get at it. So that was R1 million, went down to 900,000. So we're going to do it. And we're eliminating the accounting expense by adding it back. And we'll bring in wear and tear, which is a deduction. So 600 minus 400. That gives me 200,000. All right. And then the provision for warranty costs. It's 300. It went up to 800, so it was an expense. So we'll remove it by adding it back. Okay. And there would be no tax treatments because we told, and we know from tax knowledge, right? Case law, that SARS will only give the deduction when it is actually incurred. Right? So no tax treatment there. So what we'll do, what we'll then have is taxable income, which will just be the sum of all of this, and we're in an assessed loss position. So assessed loss carried forward. But let's just call it assessed loss carried. Let's leave it because it's going to confuse you. But we have an assessed loss here. Okay, great. So that's done. Then let's go to the deferred tax. We're already given the carrying amounts in tax base, so we can just jump straight into the temporary differences and deferred tax. So we had PPE, which had a temporary difference of 400,000, right? Giving us deferred tax. Let's ignore the fact that this is different from this. They use 28% here. We didn't do that because the year end is 31st December. Tax law says all persons whose year of assessment ends on after 31st March 2023 pays tax at 27%. Okay. Then provision for warranty costs was 300,000. Temporary difference. That would be a liability, that would be an asset, right? In terms of deferred tax. If you look in accounting, then yes, that's an asset, that's a liability. In terms of deferred tax, and you understand why, that's a liability, that's a deferred tax. Let's just call it. Someone's gonna get confused. DTA, right? Which means we had a deferred tax balance in 2023 of that much, right? And let's go to 2024. It's quite huge. Let's just take it down. Again, we're given the temporary differences. That was 500,000. It's 800,000. And again, that's a liability, that's an asset, right? Which then gives us a deferred tax balance. Oh, that's a DTA, that's a detail. Negative 81,000, but there's a problem with that, right? The problem being that in 2024, we were told that profits could not be anticipated. So it was not probable that there would be sufficient taxable temporary differences, right? And IAS 12 is clear that if it's not, you can only recognize a deferred tax asset to the extent that it is probable that there will be sufficient taxable temporary differences. So we don't know that we're going to have a deferred tax liability in the future to cancel out this 81,000, right? We don't know that. So what happens now is because we're unsure, we can only recognize our deferred tax asset to the extent of this deferred tax liability that we currently have here of 135,000. In other words, the net effect of this should be to a point where this is zero. So if it's not probable that there will be sufficient taxable temporary differences in a year of assessment or a financial year, then you cannot have a deferred tax asset. You can have a deferred tax liability, or a deferred tax balance of zero. Those are your only two options. So what we need to do is figure out how much of this we can actually recognize here. So that would only be 135,000. So we can get a zero effect, right? Which means the unrecognized portion of this, right? So just to bring you back, in total we had deferred tax of that much, 265,000. We were only able to recognize 135,000. So the remaining deferred tax asset that we have sitting here is 81,000 that is ring fenced. I'm going to put that in inverted comma because it's not a tax thing. We just ring fencing it for accounting. So don't think tax is ring fencing those things because they're not. Uh, we just FNAC ring fencing. Okay, so my journal entries are, well, if you have negative taxable income, you're not going to pay current tax, you're going to carry an assessed loss. Okay, that should be quite straightforward. My journal entries, there's no current tax. Here I can remember because it's not probable there will be sufficient taxable temporary differences, I can either have a deferred tax liability balance or a zero deferred tax balance, right? So in this case, it would be zero. So my movement, I forgot to show the movement here. My movement, I need to get from a 27,000 liability to a zero balance. So in order to do that, I'm going to have to decrease my deferred tax account with 27,000. Right? To decrease my deferred tax account, I'm going to debit it, right? And that's from the statement of financial position, 27,000. I'm going to credit income tax expense because that's the opposite leg in P&L, 27,000. Okay. Right. So that's my journal entries for 2024. Let's go on to 2025 current tax. Okay. So we'll start off with profit before tax because we were told that there was accounting profit before tax in 2025 of 850,000. Right. I'll do the same thing for depreciation. I'm just eliminating it. So it was 900, went down to 800. And then wear and tear was 400, went down to 200. Then provision for warranty costs. It was 800. Oh, okay. So let's deal with it. So provision for warranty costs was 800. It went down to 450, which means it decreased. So in essence, it's almost like an income. So to remove it, we'll subtract it, right? Because we eliminate accounting, eliminating incomes, you subtract it. Yeah. Okay. So this will be the 800 minus the 450. That gives me 350. Cool. And then no tax effect on that because then nothing was incurred. Then we will be left with taxable income before considering assessed loss. Assuming we have positive taxable income. I guess we're gonna find that out now. Yeah, we do. Then we're going to have our assessed loss carried forward. But remember that is limited to per section 20, subsection 1. It's limited to the greater of for a company, R1,000,000 or 80% of taxable income. Right? In this case, our greater amount is 1,000,000. So our assessed loss that we bring cannot exceed 1,000,000, but we only had an assessed loss of 600,000. So we could bring the full 600,000 in, but remember, you cannot carry forward an assessed loss to turn positive taxable income into another assessed loss. So you cannot use an assessed loss to create another assessed loss. Okay, so even though we had 600,000, we could bring it in full. We only had taxable income of 400,000. So that's what's going to be left. 400,000, right? Which then gives me taxable income of zero because I used everything. I've used my assessed loss against my taxable income. So again, we're in a situation where there's no current tax. Let's work on the deferred tax. So we're going to need the 2024 year of assessment, right? I'm just going to copy everything from here because I am lazy. Okay, and then remember we had that 81,000 was ring fenced in inverted commas. All right, then for 2025 year of assessment, PPE, provision for warranty costs, temporary difference of 600,000, temporary difference of 450. That's at 27%. Also at 27%. So liability, that's an asset. So we have a balance of deferred tax balance to that. Okay. Now here's the trick with assessed losses. When you're doing assessed losses, do the normal deferred tax first, like I did here. Then bring in the assessed loss at the end. So bring in the assessed loss at the end here. Now, assessed loss is not an accounting concept, so it's going to have a carrying amount of zero, right? We started off with an assessed loss, an opening balance of 600,000. We then applied 400,000 Rand against that, right? Leaving us with a closing balance now of 200,000 Rand. So a carrying amount of zero minus a tax base of 200,000 gives us a temporary difference of 200,000. Multiplying that out at 27%, or the prevailing tax rate enacted or substantively enacted, gives us a deferred tax, assessed loss deferred tax of 54,000, which means we'll then have a deferred tax balance here of negative 13,500. Hold up, wait a minute. Right, hold up, wait a minute. We need to look. We need to look now because we need to check whenever you've got a negative deferred tax balance here or deferred tax asset, you need to look. Was there sufficient taxable temporary differences? Right? Like, was there sufficient taxable temporary differences? If or sorry, is it probable that there will be sufficient taxable temporary differences? If no, then we have to limit it to this liability here, right? We have to limit it. Um, in other words, we can either have a deferred tax liability balance or a zero deferred tax balance. If it is probable that there will be sufficient future taxable temporary differences, then yes, by all means, recognize the entire thing. You can have a deferred tax asset, you can have a zero balance, you can have a liability balance. Nobody cares. So here we're told that increasing profits are forecast for the foreseeable future. So that is a trigger that there will be sufficient future taxable temporary differences. So we can have this negative amount here. So we are all good. So our journal entries with our movement, right? Remember in 2024, we wanted to go from, I cut this thing when I should have copied it. We wanted to go from deferred tax balance of zero here down to a deferred tax balance of negative 13500. So in order to do that, we need to decrease our deferred tax by 13,500. Okay? So our journal entries will look as follows. We're going to decrease deferred tax in the statement of financial position with 13,500. We're going to credit income tax expense in profit or loss with 13,500. Okay, cool. Now, let's do the required B. Okay, like I said, the income tax expense note was not required. I'm just doing it for completeness, okay? Because I want to show you all you have to do was a recon note. So IAS 12 is very clear about what it wants. The major components of tax expense shall be disclosed separately. Yeah, so let's start off with major components of tax expense then. Okay, and what is that? It consists of current tax expense. We did not have current tax in year one. Sorry, in 2024, so that doesn't apply to us. Any adjustments recognized in the period for current tax of prior periods, that did not apply to us. We did not have any adjustments to our tax expense, so that does not apply. The amount of deferred tax expense or income relating to the origination and reversal of temporary differences. Let's see, in 2024, we brought our deferred tax down from a balance of 27,000 down to zero. So we had deferred tax, origination, and reversal of taxable temporary differences, and that was 27,000. Okay, and let's go back. The amount of deferred tax expense or income relating to changes in tax rates of the imposition of new taxes. As I said, we're not going to deal with this change from 28 down to 27. Should have always been at 27, so we're just going to ignore that for now. So no, there was no change in tax rates that applies to us. There is a tutorial we can do that did have that. If you want to do it, let me know, I guess. And we can do that. Um, Then the amount of the benefit arising from a previously unrecognized tax loss, tax credit, or temporary difference of a prior period that is used to reduce current tax expense. We had an assessed loss in 2024, but there was nothing that we brought forward. So that one does not apply to us for this year of assessment. Then the amount of the benefit from a previously unrecognized tax loss, tax credit, or temporary difference of a prior period that is used to reduce deferred tax expense. We did not have that in this case, right? We had a zero deferred tax balance there. And like I said, there was nothing from the 2023 year that we had to bring forward. That information wasn't given to us. Then the deferred tax expense arising from the write-down or reversal of a previous write-down of a deferred tax asset in accordance with paragraph 56. We did not have that. The amount of tax expense or income relating to those changes in accounting policies and errors that are included in profit or loss in accordance with IAS 8 because they cannot be accounted for retrospectively. We did not have that, right? So we only had one thing. So our income tax expense was negative 27,000, right? And now let's do the recon. So tax rate reconciliation. Okay, we start off with accounting loss, right? Or profit if you had it, of 1 million rand. Then we're gonna have tax at the standard rate of 27%. Remember, it would be the tax. IAS 12 is clear. It must be the tax rate enacted or substantively enacted. In this case, it's 27%. So times 27%. That means users are expecting a tax liability of negative 270,000. We are only showing negative tax expense of 27,000. Why? We need to explain it by saying adjusted for. So what happened here, right? Well, firstly, we didn't have current tax, right? We had an assessed loss, but SARS isn't going to pay that off to us. They're going to say, no, you must use it next year, or you must use it when you get taxable income. We're not giving you money. So users wouldn't know that. So let's show them. So assessed loss arising in 2024 of 600,000 at 27%. Then what else happened is we had this 81,000 that we ring fenced because it wasn't probable that we could recognize taxable temporary differences, right? So we couldn't recognize it. We had to ring fence it. Users wouldn't know about that unless they were in the calculation. So let's show them that. That would be a nice thing to show there. Not recognize. And that was 81,000. That was the deferred tax rate, 81,000. Um, the temporary difference was actually the 200. Temporary difference was 300,000. At 27% gives us the 81,000. Yeah, we want the deferred tax, which means multiplied by the tax rate. The reason I didn't multiply this by 27% because this 81,000 already includes being multiplied by 27%. Right. Was there anything else special that happened? No, there were no permanent differences here. Now remember, this provision is not a permanent difference, it's a temporary difference, so don't get that confused just because there was no tax treatment. So ring fencing and such laws that we had. So, no. Okay, then if we did this correctly, some of this should reconcile to our income tax expense of negative 27,000. Yep. And the difference between this and this should then, sorry, difference between this and this should be 0. Yeah. So we did it correctly. Okay. Then let's do the income tax expense note for 2025. Okay, we'll do the 2025 note. So I'm not gonna do the tax expense note. I think you kind of get the point. I just wanted to show you how to read the standard to know what to put in. So let's just jump straight into the tax rate reconciliation. Okay. So what do we know here? We had a negative deferred tax of, oh sorry, income tax expense of negative 13500, right? Negative 13500. So income tax expense, right, from the note would have been 13500, right? So the tax rate recon, since that was a, remember this was the only transaction we had for the 2025 year assessment. So that was our income tax expense. There, then the tax rate recon. Let's start. So we want to get to this amount here. Okay. So let's start off profit before tax. I've given it, let's see, the and tax at standard rate of 27%, 229,500. So that's what users expect. We reported negative 13,500. That's a big, big difference. Let's show them why. So what happened? Well, firstly, we're now recognizing this 81,000. It's right. Then we had this assessed loss that we utilized of 400,000. Right. And then is there anything else? Let's see. Oh, where's my calculation? Is there profit before tax? There's a temporary differences. Again, that's also temporary difference. We already got the assessed loss. Then we got the 81 that we ring fenced. And notwithstanding, the assessed loss balance. Okay, we have this assessed loss balance. $54,000. Let me just make sure that's the deferred tax. Where's my calc? Yeah, this temporary difference. So it's deferred tax, yeah, 54,000. Okay, and then if we did this correct, we should get to the income tax expense of negative 13,500. Yeah, which we do. Okay. Right. So there we go. That's how we do IAS 12.